Good evening, Kavita. Good evening to you, to all the viewers of ET Now. So there is a thin line between a trader and an investor. The trader trades the price and the investor buys a business. The trader sells weakness and buys strength. He looks for an opportunity to trade for a few points or a few rupees or a few, percentages. Whereas the investor is putting in his hard-earned money on his spare capital into a business which he understands will generate returns over a period of time. So the thin line is the trader never becomes the investor and the investor never becomes the trader. To correlate that, if you try to trade in Infosys 10 years back, you missed the opportunity of creating the biggest wealth creator. And if you try to invest in a stock like Arcom 20 years back and you got stuck in the investment as a trader and you didn't book your loss, then you happen to own the worst stock which has been in the last 20 years. So never mix your emotions. The trader trades the price, whereas the investor buys the business or an investment which he holds for a long number of years.
Right. So can we also say that every market movement or market scenario can be a trader's market, but not every market can be an investor's market, or it's just the other way around?
So it depends on your attitude. If you're a trader, then 9:15 to 3:30 is your playground. You can enter, exit, whatever your style of trading is, whether you're a short-term trader, intraday trader, or long-term. And Kavita, there are three simple rules for the trader to follow. First is value at risk. What is the amount of value which you have at risk? Because suppose you trade the derivatives, one lot is worth something like 7 to 10 lakhs. Now on that 10 lakh rupees, there is a margin of say 25%. So on 2.5 lakh rupees, you are taking an exposure of 10 lakh. The profit and loss will be on that 10 lakh, whereas your amount is just 1/4 of that. So value at risk is very important. Second is mark to market. Every day in the derivatives, there is a settlement. So you should not be trading in a position which is loss making and where you have to cough off enough mark to market, which can again put you in peril of being over leveraged. Second is mark to market. And third is, what is your hedge? What are you hedged against? Because every day there is volatility in the market. One is the local scenario. Second is if you carry an overnight position, there is global scenarios against which you don't have if you don't have a hedge, meaning if you have not counterbalanced your risk, then again you are in a wrong position. So these three things are very, very key for a trader. For the investor, it is the scenario of trying to own an asset class. We own 4 asset classes. Everyone owns a roof over his head, which is real estate, fixed income, which manages to beat inflation and generate risk-free return. Third is gold and silver, to which we attribute to the lady of the house. And fourth is stocks. Now, do you own equity as an investment, as a portfolio? And that is an asset class which must be in every portfolio. That is why you're seeing the advent of the retail investor. So all the 4 proportions are for the business, are for the investor, and in what age is his risk profile, he will have exposure to equity. But equity as an investment is a must, because that is how your capital will grow from small amounts into wealth creation.